Hi, my name is Siener, and for my investments analysis project, I decided to look at the semiconductors and packaged food industries, pulling all of my data from Bloomberg. The first industry we're going to look at is semiconductors. We're going to look at Advanced Micro Devices, Broadcom, Intel, NVIDIA, and Texas Instruments. AMD is a semiconductor company that develops computer processors and related technologies for business and consumer markets, so they're more of a retail company. We have Broadcom, which develops as a developer that serves data centers, networking, software, broadband, wireless, and storage markets. So they're more of a service company. Then we have Intel, which is a semiconductor company that designs, markets, and manufactures computer products, delivering in markets such as personal computers, networking, data storage, and communications. So they're kind of a hybrid company. They do both retail and service. We also have NVIDIA, which is another retail company, operating as a visual computing company worldwide. Their markets are gaming, professional visualization, data centers, and automotive markets. And then we have Texas Instruments, which is a little bit more of a retail company. They still do some service things. They sell semiconductors and various integrated circuits to electronics designers. So even though that their name might not be on a lot of products, their parts are still in a lot of products. We're going to look at 5 different segments for each industry. So we have short-term solvency, long-term solvency, marketability, asset management, and profitability, market value, and asset management. Starting with short-term solvency, we can see that it's a generally solvent industry, with the peaks being as high at 7.94 for NVIDIA in gray. For Broadcom, we have a 3.9 in orange. The average is that green bar, sitting around a 3.7. Purple is Texas Instruments, sitting at a 3.2, and then we have AMD in red and then Intel in yellow, sitting somewhere around that 1.7 mark. Moving on to the quick ratios and cash ratios, they actually look like the same graph, which tells me that these companies operate proportionally the same as far as liquidity goes. NVIDIA still kind of rules the industry as far as liquidity goes. They're a much more liquid company as opposed to companies like Intel and AMD, which kind of skirt this line, even going as low as 0.58 for their cash ratio. Still able to pay their short-term things. They just might have to, get rid of some receivables and to actually pay their short-term debts. Moving on to long-term solvency, you'll notice on this chart that we don't have the average line or AMP's red line because their equity multiplier actually spiked to 1,600 in 2016, which kind of skewed the entire chart. The next highest is Broadcom at a 2.23 in their 5th year, while we have Texas Instruments, NVIDIA, and Intel sitting all somewhere between 1.5 and 1.7. So companies like NVIDIA prefer a little bit less debt and more shareholder funding, while Broadcom prefers a little bit more debt. For the times interest earned ratio, a lot of the companies, they do just fine paying their long-term solvencies, of course with the exception of AMD, who actually goes negative for about 2 years. They do manage to pull it up to 2.5 and 5.1. But it's not a super strong times interest earned ratio, while we have companies like Texas Instruments sitting at 61. As far as asset management goes, AMD does surprise us a little bit with a higher asset turnover than the rest of the industry. The rest of the industry typically sits below 1, which would normally be just a little bit concerning, but it's not too far below 1 with the exception of Broadcom, and it does seem to be an industry average. Moving on to profitability, we do have, we are going to look at return on assets and look at return on equity, and then we're going to break it down to see what the driving factors are. Return on assets, we do see this general industry curve upwards, which is generally good to see. It's showing that it's a healthy industry, and we see the same thing in return on common equity, of course with the exception of AMD, which goes negative for quite a few years, and even Broadcom goes negative but ends up pulling it back up. We do see consistent growth with companies like NVIDIA and Texas Instruments, though. And the same goes for return on common equity. With everything eventually, it looks like it bunches up, but really the spread between this is 20 and 60, so it's not that tight of a bunch. We do, see a little bit more of a spread here in the return on assets. So return on assets is a driving factor, but let's see if there's even more that drives that. As far as EBIT margin goes, this is definitely a driving factor as far as return on equity goes. We do see Texas Instruments sitting significantly higher. So after their operating expenses are taken out, they really do a great job with their efficiency there. AMD does suffer a little bit here with NVIDIA and Intel, which is kind of like floating just above the average there. Broadcom does some weird things. As far as the profit margin goes, Broadcom does excel in these later years, which is, just generally means that while they're not, while their operating expenses are a little bit higher, the markup on their products tends to be a little bit higher. But the rest of the industry all seems to float around this 20 range, with the exception of AMD, which goes negative and then eventually pulls itself back up. Going on to the tax burden, interest burden, the companies, with the exception of Broadcom, all kind of float around this 100 to about 80 range. It's a healthy range for them to all sit. Definitely not the worst place for them to be. And the industry burden is also kind of stagnant as well, with all of them kind of sitting relatively close to this industry average, with the exception, of course, being Broadcom and AMD. We do see various companies in other areas excelling more, but everyone just kind of seems to be doing the same thing as far as tax efficiency and interest burden goes. Going on to the market value of these products, for the price earnings ratio, we can see as an industry, it was a general upward curve and then suddenly took this downward spike. To me, this means that the industry was overvalued for a period of time, but the market has corrected itself, especially with these more drastic spikes. We do see that the one exception to this rule is AMD, who has a price earnings ratio that suddenly spikes to 53.49 in that 5th year, which tells me that it's definitely a bit overvalued right now. NVIDIA sits at a healthy 26.25, and Intel sits at a, kind of healthy 10.76. NVIDIA might be a little bit undervalued in this situation, and Texas Instruments might just be, just the right valuation without doing any valuation calculations. Price to book ratio, we typically want a lower price to book ratio. We do see companies like Intel and Broadcom excelling at this with a lower price to book ratio at like 3. The higher your price to book ratio, the higher, the greater the chance of your company being being seen as overvalued. So we have AMD, leading again, and then NVIDIA and Texas Instruments eventually falling to the same spot. As far as EVA and EVA spread goes, we do see that Intel is better with their EVA than the other companies, while everyone else just kind of sits around the average, with the exception of Broadcom, which kind of does some spikes here. But when we look at the efficiency of everything, we actually see that companies like NVIDIA and Texas Instruments end up doing better than other companies. We do have the average kind of sitting at sitting roughly at 10, while we have other companies sitting a bit higher. AMD does dip significantly in their efficiency, though. As far as enterprise value goes, we do see that Intel does have a higher market capitalization than these other companies, but this is really all kind of consolidated right here, with 3 of the companies and NVIDIA just kind of like hanging out down here at the bottom. I did kind of have to break it down to just 2 companies to really make a decision, and I went with NVIDIA and Texas Instruments. They really showed the best potential between the companies. NVIDIA does have a higher price to earnings ratio, with this severe correction right there to bring them back to a decent value. 26, in my opinion, is a relatively healthy price to earnings ratio. It is a bit higher than the average, but to me that just shows that investors believe in NVIDIA a little bit more than everyone else in the industry. As far as tax efficiency goes, NVIDIA is a little bit more efficient as far as from a tax standpoint, with Texas Instruments being a little bit lower. They are both lower than the average though, but that partially has to do with some of the weird spikes with Broadcom and AMD. As far as EVA and EVA spread goes, we do see that Texas Instruments is better with their capital costs than NVIDIA. NVIDIA does rise with Texas Instruments for a while, but then ends up actually falling off a little bit, and the same goes with their efficiency here. So historically, Texas Instruments is just a little bit more efficient with everything. Moving on to that driving factor of common equity and back to common equity, we can see that the equity margin, or the EBIT margin for Texas Instruments is about 10 points higher than it is than NVIDIA's, but they're both still above the average, so they're still performing above average for that industry. And this common equity only has a difference of about 8, which isn't that big of a difference. Historically, Texas Instruments has performed a little bit better. As far as this 8-point difference in the common equity, I think this can all be in a way traced back to the equity multiplier. We do see that NVIDIA does rely a little bit less on debt and more on equity in this sense, so they have more equity than, proportionally at least, than Texas Instruments does. So naturally their ROE would tend to be a little bit lower, just because they have a decent bit more proportional equity than Texas Instruments. Ultimately, I did have to pick one of these two companies. I went with NVIDIA for a number of different reasons. The technology industries, they're typically more volatile industries, especially the semiconductor industry, with their higher solvency ratios. I feel NVIDIA is a little bit more stable and more survivable in that volatile market. Additionally, we do see some hints from the price to earnings ratio that investors typically believe more in NVIDIA than other companies in that industry. Moving on to the packaged food industries, we do have Campbell Soup, General Mills, Kellogg, Kraft Heinz, and Tyson Foods. Campbell's is a famous company. Everyone knows their soups. Everyone's probably had their soups at some point, but they also make beverages and other packaged meals. General Mills, cereal company. They make branded and unbranded foods as well as pet foods. So not only do they make the cereals they're known for, but they also make some of those generic brands that you'll see in the stores. Kellogg Company manufactures and markets ready-to-eat cereal and convenience foods. Kraft Heinz is actually a company from a recent merger between two former industry powerhouses. We can kind of see that they, historically they kind of fell off for a little bit, which is why they did merge. They make condiments, dairy products, meals, meats, and beverages. And finally, Tyson Foods, which is a modern protein-focused food company that sells to all major retail distribution channels. Starting off with the short-term solvency, we can see considerable differences between this industry and the semiconductor industry. This industry typically is not as solvent as the semiconductor industry, but that's okay. We can see that some of these companies, even with a cash ratio, their current ratio is less than 1, which is initially startling, but when you look at it and realize that that's just how the industry operates, as long as they're not sitting too far below this average, everything's going to be okay. We do see Tyson kind of leading everything off in purple, Kraft Heinz in gray, the average again in green, General Mills in this orange, Campbell's in red, and Kellogg's in yellow. This industry isn't as unified, I guess is the best word, as the semiconductor industry. So you can see each company really has its own strategy as far as these quick and cash ratios go. So some companies prefer to have more cash than others. Before, in the semiconductor industry, everyone kind of stayed in their spots. Here you see a lot more variation with just the general less liquid industry. So with the quick ratio being as low as 0.28 and as low as 0.06 in some cases. For long-term solvency, we do see that this industry does like debt a little bit more, with the debt being as high, or with the equity multiplier being as high as 7 in some cases. With Kellogg's and Campbell, the industry average sitting around 4 with General Mills, and you'll actually see throughout this presentation that General Mills likes to float along that average line as well. And then Tyson and Kraft Heinz sitting on a low, but an industry low equity multiplier of around 2, showing that they prefer more shareholder support than debt support. As far as the times interest earned ratio, we do see that these companies, most of them don't really have a problem paying back their long-term obligations, with the exception of Kraft. You know, really getting even negative with their times interest earned ratio, very unfortunate. But you know, Tyson kind of leading this industry with theirs, staying historically above other companies, while other companies tend to take this downward spike into that 5th year. As far as asset management goes, all the companies kind of float around this 1, with this number of 1 within some reasonableness. We see a little bit of a dip with General Mills here and Kraft Heinz sitting kind of low, and then Tyson kind of leading the industry here. With this being a retail market, this asset turnover being high is kind of key. As far as profitability goes, we do see some variation with this return on asset initially, but this is only a 10-point spread. So while Tyson is, it looks a bit higher than Kellogg's and General Mills and Kraft and Campbell's. Well, everyone's higher than Kraft in this situation. Tyson does do a better job at return on assets. However, Kellogg's does kind of lead this common equity here. We do see an industry trend in both return on assets and return on common equity of this general upswing, with a slight deviation to the bottom. We also see Campbell's kind of starting high, dipping down, coming back up, and then plummeting all of a sudden. And then Kraft Heinz is also just suffering and trying, struggling just to kind of stay out the negative with the return on common equity. Really, we want to see the driving factors. Return on asset is, some part of return on assets is a driving factor here. We do see relative stability in the EBIT margin, with a general difference of about 8, with of course Kraft Heinz kind of ruining any type of average that we have here. Profit margin, again, the industry itself just kind of stays relatively stable. None of the companies really deviate too far from each other. They all kind of stay in line as far as EBIT and profit margin goes, which shows that there's not, you can't really take those profit risks in these industries, and you really have to keep your operating expenses down in order not to fall behind. We do see more variation as far as the interest burden goes, more of a spread going on there. Tax burden does remain a little bit tight, with Kraft Heinz doing some funny things in both the tax burden or tax efficiency and the interest burden over here. So interest burden is kind of a driving factor as well. In some sense, you could argue EBIT margin and overall return on assets as a driving factor in this industry. Going on to the market value, we do see a sudden spike in Kraft Heinz because everyone was super excited when they merged and got back on the market, but then we see a drastic decrease back down to the industry average, where the spread is about 4. Price to book ratio really kind of makes the difference here. We do see that companies like Campbell and Kellogg, you could make an argument that they're a bit overvalued compared to companies like Tyson and Kraft, who have a relatively low price to book ratio. As far as EVA and EVA spread, we don't really see too much of a spread here in EVA, so they all handle their capital costs pretty well. However, we do see companies like Kellogg and Tyson are actually a little bit more efficient than other companies like Campbell and General Mills and obviously Kraft Heinz in this situation. So really that efficiency in this situation is the key factor. As far as enterprise value goes, we did see a general rise in market capitalization for Kraft Heinz, while everyone else just kind of stays within that $20,000 to $40,000 enterprise value range. We do see this general decrease in Kraft Heinz, and we can kind of expect that to continue decreasing based off of their lack of consistency in their ratios and their general lack of performance. Again, like I said earlier in the presentation, we do see that General Mills kind of floats, kind of stays along that average line, just going back to some of those ratios, not really ever doing anything to stand out about everyone else. This flat enterprise value and this even decrease from Kraft Heinz shows that there's not really too much growth going on in this industry. It's a very stagnant industry. Had to bring it down to two companies though, Kellogg and Tyson. Tyson does rely on a little bit more debt, which in a way explains their lower times interest earned ratio. With this being a super insolvent industry though, we should probably rely on a little bit more of stockholders' money than debt. So I kind of agree with Tyson's stance on a lower equity multiplier, which does give them a higher times interest earned ratio in this situation. As far as return on assets, in a retail industry, this high return on assets, since we're zoomed in on it, only being 2 points higher kind of makes a key difference for Tyson in this situation. As far as price earnings ratio though, we do see the spike in the average, but if that spike wasn't caused by Kraft Heinz, I'd imagine the average would sit right along Kellogg's in this situation, which means they're kind of performing how the market thinks the industry as a whole is going to perform. We do see Tyson a little bit below that average, or lower than that average, which makes me think that they're actually a little bit undervalued right now, which could make them a hot buy. Like I said, their asset management is kind of key, especially in a retail industry. So we do have Tyson sitting with a significantly higher asset turnover, while we do have Kellogg's just kind of sitting at that average there. So that higher asset turnover ratio, as well as their general more solvency in the industry, is kind of why I had to pick Tyson. There's also other factors like the general trend for healthier eating. Tyson typically provides more products that fit in with these fad diets that we're seeing, like paleo and keto. There's still a packaged food though, so some people might stray away from them. Between Tyson and Nvidia, really I just had to go with Nvidia for the same reason I had to go with Tyson over Kellogg. As far as industries go, that packaged food industry as a whole is suffering from I call them fad diets, but it's typically a healthier living style. People don't want packaged foods, they want farm to table foods. While Tyson can provide some of those products, it doesn't really help with their growth. Meanwhile, Nvidia, while it's a volatile industry, as technology continues to grow, it just shows more and more growth potential for Nvidia. As far as the valuation of Nvidia stock, I did use two different methods to find out if they're overvalued, if they're a good buy right now. The first target price that I calculated, I used by taking the trailing 12 months earnings per share, multiplied by net income growth from the last 2 years, and multiplied that by the 5-year price to earnings average, which gave me a target price of 238.68, which is significantly above the 175.07 current stock price, meaning that it's currently undervalued. You should never just go with one calculation though, so for the second calculation I did the dividend discount model. All this information up here was pulled directly from Bloomberg. I did have to calculate a couple dividends per share, but ultimately I got a valuation of $239.24, which isn't too far off from that $238.68. It's about a 60-cent difference, which is really close. It just kind of strengthens that valuation. You could realistically value this company for about $239 as a safe bet, which is still above that 175.07 of the current price. So this stock, Nvidia stock, is It's really underpriced. A lot of analysts are recommending this as a hot buy, and I really think investors should invest in this company. Thank you.